Hello and welcome back to the complete day trading course by Wealthy Education. In this video, we'll take a look at diamond tops and bottoms. Diamond tops and bottoms refer to support and resistance levels in a chart, at the top obviously being the top of the market, bottom being the bottom. And what happens is you get markets that go and they find support and resistance, a downtrending support line, and a broadening pattern, if you will, and then a shrinking pattern. And then eventually, in the case of a top, it breaks down. Diamond top. So you can literally draw for support and resistance trend lines. Now, in the bottom, it's the exact opposite. You have price drifting lower, and then it broadens a bit, and then it tightens, and then it breaks out to the upside. Now, why is this significant? Really, what you should be paying attention to here is that the market is widening, and then it's tightening. That means it's coiling up like a spring. That's really the most important part about this. It's not the diamond shape itself. So, looking at this tells you that you are going, in the case of a top, you're going higher, and then the market's getting more and more volatile. There's a lot of indecision, and then everybody kind of calms down, and then we break down because we are concerned, and then suddenly something changes. It is a pattern that has a measured stick built into it. It's a little bit of a subjective pattern, so I invite you to experiment as to whether or not you can find them cleanly. Not everybody can, but in this case, we have a diamond pattern at the top of a move higher. You can see that there is a support line and a resistance line that are widening, and then do the opposite after a huge and substantial move to the upside. On the breakout point, what are we looking at here? Well, what we're looking at is a move that projects to the same distance of the diamond itself. And you can see that clearly that's exactly where we got. Now, it did take the second day of trading into this pattern to hit that target, but you would have certainly gotten close enough by the end of the first day. Also, I would point out that the stop loss is pretty easy to do because either the pattern works or it doesn't. So you just put it on the top of the candlestick inside the triangle that led to the sell-off. That way you can mitigate your risk. Now, again, the one downside to these things is that they are a bit subjective, and a lot of technical traders don't like that. But they happen enough that they are worth paying attention to. But again, you can make an argument for a lot of diamonds in a lot of different places. Unfortunately, all it takes is being creative with trend lines. So what I suggest is focus more on the fact that you're in a trend, and then things broaden, and then they tighten, and then there's a move. That's really what you need to be paying attention to, as opposed to whether the lines are perfect diamond. Like I said, it's kind of a subjective pattern, but it is a pattern you hear about. A lot of times, like ultra short-term traders will look at them. And then you're talking about much smaller moves. But they do work in that sense, just because volatility starts to get wild, and then it disappears, and then it explodes to the upside again. But as you can see here, I can make an argument for a diamond pattern here, even though, a lot of people could argue against it, and that's where you run into trouble with this particular pattern. But there is a diamond pattern there, as shown by these trend lines, and it does, in fact, reach the target. So read into it what you will. Another thing that you should probably pay attention to, like in this case, we've rallied significantly the market looks a bit confused, and the market will naturally pull back a bit anyway. So that's another way to look at it. It does tend to be a little bit more helpful on the very short-term chart. So this is a 3-minute chart, for example.